People still think credit is about who you were, meaning in the past. A number, a score, a static snapshot built somewhere inside, institutions like our credit bureaus. And for a long time, that worked even. But because your financial life didn't move this fast, salary came in once a month, spending was predictable, death was visible. So a backward looking score was good enough. But look at how money behaves today. It moves constantly across accounts, wallets, credit lines, sometimes even within hours. You are not one financial profile anymore. You are a series of decisions playing out in real time. And yet, we are still trying to summarize all of that into a single number. Well, my friends, that model is breaking very quietly but decisively. Before I move on, welcome to the Strategy Spark podcast. You are listening to me, your host, Sanghamitra, and thank you for tuning in. If you like these kind of content from me, please do like, share, and spread the word. It helps the algorithm and also helps our viewers. Thank you very much. Back to the topic. So, what's replacing our current credit scores isn't just a better score anymore. It's a different way of thinking about risk. In my head, it is moving from being static to contextual. From who you were, that means in the past, to how you behave now. So let's take something very simple, two users, same credit scores. One manages cash flow with a lot of discipline, let's say. He or she keeps buffers, repays very early. But the other one runs close to the edge, repays on time, but only just, spikes in usages and cycles through short term credit. Well, in the old system, they might look very identical, but in the new world, they are not even close. And that difference is no longer sitting in a risk team somewhere. It's embedded inside the product itself. So every interaction which is happening is becoming a signal. When you repay, how you spend, when you start looking for credit, even if you don't take it. So, not because the system is collecting more data, but because it's interpreting behavior differently. Even if, it's through lightweight models running in the background. So, credit is no longer a one-time decision. It's basically continuous because limits adjust, access changes, pricing are shifting, and sometimes without you even noticing all these. You don't apply to credit anymore. You basically exist within it. And I think that's a fundamental shift because now the system isn't just evaluating you, it's responding to you in real time. But here's where it gets a bit uncomfortable, I would say. When decisions moves this fast, they also become very harder to see. You don't know why your limit changed. You don't know why you were eligible last week, but not today anymore. You just are experiencing the outcome. The system is understanding your behavior better than ever now, but you understand the system less. And that's, I think, a trade off we have created. We have given the systems more precision, more access, but very less clarity or even less transparency. So the shift here isn't just from credit scores to context, it's more from visible judgment to embedded judgment. And if you are building in this space, this is the question that actually matters now, not how accurate your models are, but how legible your decisions feel to the end users. Because when finance becomes this dynamic, trust doesn't comes from just being right. It comes from being understood. So any product which is playing with all these models and workflows and credits or even these related workflows, I think the end goal should be not just to onboard customers and give them something contextual or a score, but also help the customer to stick to your product because of the clarity and the transparency. I would say that's the user journey we should aim for. Thank you for tuning in, and this was your small spark short podcast. If you got something from this, please like, share, and spread the word. Thank you again. Bye.